Hi, I'm Don McCulley.
And I'm Andrew Kuykendall. Welcome to another episode of This Stuff is Complicated, where Don and I try to distill our 50 years of knowledge, some of it learned the very hard way, and make this crazy business a little more understandable.
So the topic today is something that was invented by William Heyman at the Hughes Research Lab on May 16, 1960. Do you know what he invented on May 16, 1960?
What's that, Don?
The laser.
The laser, the all visible spectrum of light, just like my shirt.
Well, there you go.
But we're talking about a different laser today.
You sound like a science guy all of a sudden, but let's stick with stop loss.
I've been called worse.
Okay, that's great. So what is a laser? And a laser is an extra contractual liability for the employer or the plan sponsor, as we call them also. What does extra contractual liability mean? Well, it means it's not part of the specific stop loss contract, and it's not part of the employer aggregate contract. It is outside those. Extra contract. That's the definition in our world. And what it means is that particular claim, which is known now, is not subject to carrier overhead or state premium taxes. It's a self-insured risk for the employer. It is the purest form of claims reimbursement. It is the most efficient way to pay a known, ongoing, large claim.
So generally, these are going to be associated with very large known risks. Using the example of a $100,000 stop-loss deductible, we would expect to see lasers starting at $200,000 or $300,000 for a known ongoing risk, as you defined it. But how does that morph or change if you are in a platform like a stop-loss captive?
So you've already touched on one of the highlights there.
Oh, okay.
You correctly noticed that if you had a $100,000 individual specific limit, that the first laser would attach probably at a $200,000 number, because we are able to absorb in what's called a known risk pool, at least in our program. Every program might be a little different. In our program, certain known risks. So we would not even be charged in many respects for claims that are, say, $25,000 or $40,000 above a $100,000 claim or individual specific limit. Having said that, a known risk pool, a laser pool, absorbs known risk anywhere between 10 and 40% for the renewal year coming up. And why we do that is we're recognizing the perpetual nature of the program and the fact that the employers have built up some goodwill. They've got collateral. They've been involved in the program. And we are doing something collectively paying claims. We're bigger than just any one employer. We're a credible population, so we can absorb that. It's an accommodation for the members.
So when you reference that known risk pool, that is then spread across the entirety of the population of the captive. And not everybody's going to hit every laser every year.
Well, as we often say, and our underwriters don't like to hear it, 100% of lasers are wrong.
And some will come in a little hot, some will come in a little bit lower, but
they're
it's
never on the penny. So they're 100% wrong. We're going to hang our hat on that item right there. So having said that, the known risk pool absorbs those known risks. What's a manageable known risk? Well, breast cancer, which is a 12 to 18 or 24 month cycle, prostate cancer, some of those more, they're all bad.
Common.
They're all bad, but yes, the more common cancers. Mm-hmm. Those are manageable. We know what the drug protocols are. We know what the survivability rates are. That works. Then you get into the areas of kind of less frequent claims, but high cost, narcolepsy, cystic fibrosis, where they're $300,000-$400,000 a year. They're ongoing and they're large enough to cause pain, but not enough to go above what I call the group specific limit. Because it goes above the group specific limit, it's now outside our ability to absorb that risk. So going back to narcolepsy and cystic fibrosis, those are things that we need to figure out some way to pay for that every year. And so that is where a laser might be applied. Now, we haven't done it when we've had those cases come up, because we've been able to largely avoid lasers in our program.
And unfortunately, even though it is an ongoing risk, and we've seen it for 3 or 5 or 10 years in some instances, those are still subject to medical inflation. So what you're paying today is going to be more the next year. And then we do push up against that group limit.
And when I want to punch underwriters, or you, as I often threaten but never actually do, it has to do with using words like credibility and medical trend, which I just don't like. But let's talk about no new laser contracts, because the no new laser rate cap has become a very popular selling tool and a marketing tool for some. So let's first go back to what contracts in insurance mean. They're contracts of adhesion, which means if one side pays a premium, lives up to the policy, the other side cannot say no. And so we're in a situation where the laser and a contract of adhesion merge, and it's often considered a point of pain. So you then revert to a no new laser rate cap, where you buy a filed policy from your insurance carrier that's rated, and that's a 1-year policy. And if that laser cap isn't invoked, then you buy it for another year. And that's typically 3 to 8% of your stop loss premium, not aggregate premium, just stop loss premium. So that charge goes in there, and then you should get credit for that charge when the no laser rate cap goes away. That's a 1-year, can be renewed. Even if it's used, that's underwriter discretion. Anybody that says they have a perpetual no new laser rate cap, that is a commercial contract. It is no longer a contract of adhesion. And if someone chooses not to live up to that obligation, that requires litigation to collect, because unless there's a mediation clause, collecting outside of insurance is a commercial contract.
Now, what about some of the mechanisms we've seen, thinking of like an organ transplant insurance policy or some of those other opportunities to get around the laser liability?
Wherever possible, we want people to buy organ transplant policies. There's 3 major programs to do it. It's typically not available if you're on a blue contract. They won't let the utilization management switch to the organ transplant. But that's an excellent question. But let's do a recap of what we talked about, because there's really 3 things. We talked about what is a laser, not the one invented at the Hughes Research Lab. We talked about a laser pool, and then we talked about no laser contracts. And in a nutshell, if you understand those 3 things, you understand that unquantifiable risk that can pop up periodically because claims happen in an asymmetrical manner.
Absolutely.
All right. Well, I'm Don McCulley.
And I'm Andrew Kuykendall. Thanks for joining us. We'll see you real soon.